Okay guys, welcome back to the video series. And where we left off, we were talking about our traditional banking model here and understanding more about our chess pieces. And what is the difference here between a line and a loan? Well, for starters guys, these are the two primary products that banks offer to consumers. What is a loan? A loan is a one-way lending instrument where you have a fixed monthly payment and each payment consists of principal and interest, right? And it has what's called an amortized repayment schedule, where at the beginning of your loan, you're going to see front-loaded interest. Like a big chunk of your payment is going to be interest right off the bat, especially on a mortgage. It's going to be interest right off the bat, and a smaller portion is going to actually affect the principal. And then over the life of the loan, okay, it actually evens out. But that's an amortized repayment schedule. I'll show you an example later here in the training. And when it comes to loans, right? A loan, this is the product the banks most readily offer. I mean, most people are pretty familiar with loans. We got student loans, mortgage loans, car loans, right? So most people are pretty familiar with loans and probably have loans. And the biggest problem with loans, the biggest problem here is that the principal is not liquid. Okay, so you do not have access to your money. So even though you send in principal every month on that payment, okay, so in our example, we have the $600 car payment. If 300 of it is principal, 300 of it is interest. Once you send in that full 600, you never get to access that 300 of principal ever again, right? If an emergency comes up, you send an extra principal on the loan, you can never re-access that money, okay? And why? Because the banks have it, right? And once the banks have it, they get to leverage your money. Okay, so again, loans are a one-way lending instrument. You can put money in, but you can't take money out. Okay, now is it possible for you to create leverage with your money like the banks do? Yes, okay, the good news is the answer is yes, but you just can't do it with loans. So what is a line of credit? Well, a line of credit is a two-way lending instrument. Okay, that means it's revolving. And there's only a payment if there is a balance. Okay, so if you have a zero balance on your credit card, there won't be a payment. There won't be any interest. The payment reduces the principal balance and then interest is charged at the end of the billing cycle. And it's just got regular simple interest on this line of credit. And over the course of our lifetime, we are taught that lines of credit are bad. And the bottom line is, a line of credit is a tool. Okay, and most people are just never taught how to use lines of credit correctly. Most people use lines of credit for liabilities. They use it for their big screen TV. They use it, critical point to make here, guys, is that lines of credit, they are for emergencies and for the acquisition of assets. That's it, okay? And if you limit your exposure to lines of credit to just those two things, lines of credit can be very, very powerful tool that you can use inside of your toolbox. Okay, and the great thing about lines of credit, okay, when you send money to lines of credit, is that the principal stays liquid. Okay, you have access to your money in the form of leverage in the line. So like in our example, we have a $12,000 balance on that credit card. If we sent all $5,000 to that credit card, it would knock the balance from 12 down to 7, right? Do we still have access to that $5,000? Yes. Okay, because we've created that new available credit in the line that we can access, that we can leverage. And we can leverage that to build wealth, just like the banks do. And this is what gives you the ability to leverage your money instead of the banks. Okay? Bottom line, key point here is if you aren't going to leverage your money for financial gain, the banks definitely will. Okay? So, and that brings us back to our critical example. And now that we understand a little bit more about the difference between lines and loans, we know that loans have an amortized repayment schedule. That means they front load the interest. And it's also just a one-way lending instrument. We can put money in, but we can't take money out. When it comes to our lines of credit, we know that they just go by daily simple interest. Okay, and it's also a revolving tool. We can put money in and we can take money out, which gives us access to the leverage. And so now that we know a little bit more about these tools, let's take the next step here. Because what is the difference here when it comes to the interest? Why do we see the big 21% when it comes to our line of credit, but we only see 6% when it comes to our loan, right? Does that mean that we're gonna pay less in interest, right? And a critical question to ask you, hey, if you were gonna borrow some money from me and I asked you, Would you rather pay a 6% interest rate or a 21% interest rate? What would you choose? Okay. And, what I'm going to share with you is that sometimes 21% is actually cheaper than 6% when it comes to the interest rate. I'm going to show you why, and I'm going to show you how. And we're actually going to uncover that lesson in the next training.